Hey guys, Joel Frank here, market analyst for YouTrading. And in today's video, we're going to be taking a quick look across markets, talking about some of the themes that are currently in play and how things could potentially play out for the rest of the week. So let's jump straight into the charts here. You can see, so it's actually market closures today in the US and in most European and sort of markets in the Americas as well, because it is Easter Monday, but we're still seeing futures trading. So we're seeing Nasdaq 100 index futures, as represented here by a CFD that tracks them, down around about 1%. Let's go to the S&P 500 or a CFD that tracks the price of the S&P 500 future. That's down 0.8%. We're seeing the dollar index pushing a little bit higher, breaking. This is important potentially from a short-term technical perspective, but we were in this downtrend, breaking above it a little bit, looking to test the 21-day moving average, potentially go back to some support turned resistance around 103.50 and the 50-day moving average. Yeah, we could potentially have a look at those levels this week. Yields moved higher last Friday, consolidating that jump in yields. Same with the 10-year broadly. Gold pulling back a little bit, but still, doing decently on the year. Oil consolidating still within recent ranges, continues to struggle to push above this key resistance area. I mean, we're about 80. We can't seem to even test 83, 84 as demand concerns remain. But the main reason we're seeing downside in stocks, upside in the dollar, and upside in yields is a kind of delayed reaction, you could say, to last Friday's US jobs data. Let me show you on the chart. Pretty much it was broadly in line with expectations. But, well, actually, I mean, it was a little bit better than expected. The headline number, couple of K above the expected, and we saw decent positive revisions to the prior. Unemployment rate was a little bit better than expected. Average hourly earnings were in line with expected month over month, a little bit weaker year over year. But the main thing to note here is that this jobs report did give a modest boost to expectations that the Fed is going to go with another 25 basis point rate hike at its meeting at the beginning of next month. I think that probability currently stands at around, what were these guys say, around 65%. And that's up from, in wake of that string of weak data that we had towards the start of last week or in the first half of last week, that dropped to like 40%. So pretty much we're just pricing in a slightly more aggressive tightening cycle from the Fed. One more hike, I think, is what markets are pricing in at this point, and then cuts later in the year. I mean, the thing is, the labour market's still humming along nicely. Yes, the JOLTS data last week wasn't good, shows labour demand is starting to crack, but labour demand is still at decent levels, around 10 million job openings at the end of February. That's still good. The worrying sign is more to do with economic activity, with the weakness in last week's ISM PMI data, the manufacturing and the services, both much weaker than expected. The manufacturing signaling there's a recession in the US manufacturing industry. Services, okay, we're not in recession in the US service sector yet, but it looks like we're heading there soon. So how long can the labour market hold up in the face of a recession? Well, you got to think that cracks are going to be coming eventually. So I still think that we're probably going to be in a situation where the Fed's cutting interest rates later this year. There was some interesting chatter on Twitter regarding some other data that was released last Friday as well. I should have gone back and found those tweets, but pretty much to summarize it off the top of my head, bank lending contracted at like its fastest rate, I think, since the financial crisis, basically, in the final 2 weeks of March, in wake of the collapse of those banks. So basically saying that the credit crunch has begun. So not only have you got the delayed headwinds finally arriving from all the Fed's tightening last year, which is slowing the economy, and we're now seeing that in the data. You've also got this sudden shock, which just happened to the financial system, the sudden collapse of basically 3 banks last month, which is going to cause a lot of the other banks, or seems to already be causing a lot of the other banks, to be taking a much more cautious approach, focusing more on consolidating their balance sheets so that they're not next, rather than lending at the same pace that they were lending before. So that's another big economic headwind, and just further, in my mind, raises the risk that we're going to be in a recession in the US sometime in the second half of this year. So, how much are stocks really going to sell off? I mean, I still think the Fed rate cutting story's there and can be supportive, but, you know, recessions tend to be negative for stocks. So we're just going to have to see. We do have earnings season, by the way, coming up this week. A couple of the big banks are starting to post earnings before the end of the week. That unofficially kicks off the Q1 2023 earnings season. That will have a big impact on sentiment in these equity markets. Consensus expectations, what was it? Yeah. Analysts expect the S&P 500 companies' profits to shrink 5.2% in the first quarter. So we're in an earnings recession already, according to these expectations. That's been revised down from what we were thinking at the start of the year, which was no earnings recession. So, yeah, that's pretty much where we are. And then actually, when you think about that, it's like at the start of the year, stocks were lower than they are now. Yet at the start of the year, we weren't expecting an earnings recession, at least to begin in Q1. Well, now we are. So it's like, how have these stock values gone up, but earning expectations have gone down? Well, we know how, because yes, earning expectations have gone down, but the risk-free rate, US yields have gone down as well, which pushes up valuations by basically the support of lower interest rates, because of these expectations that the Fed's going to start cutting later this year to stave off a recession and a banking crisis and a credit crunch and blah, 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 all that kind of stuff. But anyway, let's not ramble on too much. Let me get back to the calendar. Let me get back to this week as well. There we go. Let's talk about the main events. Okay, it's a big one. Big week coming up. Okay, Monday's dead because obviously Easter Monday, nothing's happening. Tuesday's pretty much dead as well. Bit of Fed speak to keep an eye on. Some loan data in China, which is a good lead indicator of economic growth there, but it's not going to have too much effect on US markets anyway. Global forex markets probably not. This is the biggie. US CPI for March. Expected to see a big drop, actually. Look at that, 6% to 5.2%, and we're expected to go from 0.4% to 0.2%. And then the core to 0.4% from 0.5%. Core's still a little bit too hot. So 0.4%, that's still high. Shouldn't be too much optimism on this report. But if things come in as expected, that is a good progress. Is a good progress, that's how you speak. That is good progress back towards the Fed's 2% inflation goal. You can't complain about that report. Like 5.2%, considering we were above 9% mid last year, this inflation in the US heading in the right direction if things come in line with expectations. Obviously, if there's a big downside miss on this, then you could potentially see a big rally in risk assets like stocks and crypto. You'd see yields down, you'd see the dollar down. Of course, if the inflation stays a lot hotter than expected, you could see the reverse reaction of that. Sticking with the US though, Fed minutes on Wednesday, a smattering of Fed speakers throughout the week, like I said, Harker, who else is speaking? Waller on Friday. There's a couple of others that aren't on this. PPI, of course, very important. Retail sales out of the US on Friday, and the preliminary University of Michigan Consumer Sentiment Report, including that inflation expectations number, which was so important in 2021 and 2022. People paying a little bit less attention to it now, but as long as that continues to decline, sort of feeds into the deflationary story, or the coming back to the Fed's inflation target story. And then for other G10 countries, there's actually quite a lot going on as well. So like Bank of Canada meeting on Wednesday, BOE Governor Bailey speaking twice actually on Wednesday. UK GDP Thursday, Canadian Bank of Canada Governor Macklem speaking. So keep an eye on that. Aussie jobs numbers as well on the Thursday Asia Pacific session. But late on this calendar, it says late on Wednesday, but that is during the Thursday Asia hours. So, if you're trading those pairs, keep an eye on them because they could have an outsized impact. But yeah, guys, that's pretty much the main stuff to be keeping an eye on this week. Obviously, the earnings as well, which we already talked about. So, yeah, I hope you all found the video informative, helpful, and I will see you guys all in the next one.